Hello and welcome back to The Note. Small caps are on a tear. They've been beating large caps very persistently for some years now, leading to many people fearing that they are overvalued. But how exactly do you value a small cap stock, and does it really matter anyway? With me now to help answer those perhaps slightly heretical questions is the Director of Research at Wainwright Economics, David Ranson. David, thanks for joining me once more. Let's start by taking a look at the raw performance figures, and you can see that basically small has been beautiful over the last decade or so. Why do you think small caps have been outperforming to the extent that they have?
Well, I think first of all they of course had a deeper dip in 2008, and so they had a good opportunity to come back. And after that, though, you might have thought, having had this tremendous performance, they would underperform, and that has not been the case. So there's a little bit of a mystery there. But I believe the reason for this is that small cap stocks benefit more from what I call the prevailing economic winds, which have boosted the whole US equity market so well for the last 2 to 3 years.
Okay, let's now take a look at the thorny question of valuation. Now these are a table that you put together. They're both measuring the same group of 2,000 companies in the Russell 2000, and yet they come up with hugely different versions of exactly what the valuation is. Why do we see this difference between Bloomberg and FactSet?
Well, this is a case of the devil is in the details. If you weight the companies one way, then companies that have extremely low earnings, and in some cases negative earnings, are going to play a much bigger role in the ratio overall, and then you get a high PE ratio like the one that we saw with Bloomberg.
Right.
And if you weight them differently, you'll get a lower one, and there's probably hundreds of different ways to weight them, so there's no single index that's going to be accepted by everyone.
But the essential problem is what on earth do you do when you actually have the phenomenon of negative earnings, or when a majority of companies actually lose money?
So the FactSet looks better because it didn't have the break, but the Bloomberg data have the break because at some point the earnings get so low, even on an index basis, they go past zero and the PE ratio becomes infinity.
Right, so in late 2009, which we now know was a great buying opportunity time, we had no opinion at all on valuation looking at it that way. No sensible valuation could be attached to them on that basis.
Yes, it's a strong sell signal if you believe in PE ratios, but it would have been a very bad move.
Now, you now also took this data and inverted it so that we're now looking at the earnings yield. This begins to rescue some of the differences in opinion that we see there. Why did you invert?
Yes, well, if something can go through infinity, it's got to be nonsensical at that point.
Yes.
So that means there's something mathematically wrong with it over the whole course. So if we just turn it upside down, we get rid of the mathematical problem. So we look at the E to P ratio instead of the P to E ratio. We'll get much the same information, but we won't have to worry about breaks in the series as we had with Bloomberg. Bloomberg didn't have to have a break in this case if they'd done it this way.
It could just have gone negative.
Yes. Now,
this, I suppose, leads to the critical question. There's a lot of research suggesting that the critical point to whether you're going to make money from a stock investment is how cheap it is when you buy it, that you can gain from mean reversion. We've obviously had mean reversion from the bottom, from the panic. Shouldn't we therefore also fear mean reversion back from whatever euphoric highs we're at the moment?
Well, this is an assumption a lot of people make, but it turns out empirically mean reversion is not symmetrical. There's a tremendously strong tendency when stocks, either large or small cap stocks, when they're cheap, they do rebound, and there's a reason why they're cheap. It's generally a recession or a panic, as you say. But there's no corresponding tendency for big spikes and abrupt declines. When stocks do well, they do it over much longer time frames. It's quite unsymmetrical.
Okay, David, thank you very much indeed.
Thank you.
That final insight, I have to say, tends to contradict a lot of what I have written about valuation over the years, but it does seem to make some sense. Mean reversion, plainly, is a very important concept whenever you're trying to invest in the stock markets, but maybe mean reversion isn't as symmetrical as some of us assume.